Let's bring in Gabriela Santos, Chief Market Strategist for the Americas at JPMorgan Asset Management. You heard Waller there. I'm curious to get your thoughts. Is one going to give, and which one?
So I think it's interesting that even Governor Waller, one of the most dovish members, is also repeating what we hear from other Fed members, and we saw in the minutes released earlier this week, which is that this is really just a normalization of rates. This is not an accommodation of policy. And I do think the futures market is now better priced for it versus peak dovishness in September. Rate cut has been taken out, and it's just 100 basis points over the next year to get us to that neutral of about 3%. I think that's the right reading. In terms of which one will give a little bit more, we think it's the GDP report. It's been particularly strong. Second quarter over 3% is our estimate for the third quarter as well. But we don't think the momentum is accelerating that much. So we might actually get a pretty weak report in the fourth quarter. We're not saying recession by any stretch, just that there's a lot of noise in the data. And if you look through it, it's an okay economy, not a red hot one.
What are you looking through when you say a lot of noise?
Yeah. So the first half of the year, so much noise from net exports, subtracting 5 percentage points, then adding 5 percentage points from inventories as well. And then beneath the surface, for the consumer specifically, very weak first quarter, and then a strong rebound in the second quarter into the third. When we look at our Chase data for high frequency data, we're seeing a little bit of a slowdown in October in consumer spending, especially around discretionary. So we're very interested in hearing from the consumer companies later in the earnings season, which is about to kick off, exactly how much of a slowdown have they been seeing here going into October. Again, no major alarm bells, but just one reason that we're cautious about some of this very cyclical rally in the market we've seen since the middle of the summer. So very unprofitable, cyclical type of companies rebounding, and we think that's a bit short-lived, given that it's just an okay economy.
And I know typically the equity markets don't respond to government shutdowns. I guess the longer they go on, potentially there is some reaction there. If some of these furloughs do turn into permanent layoffs, though, could that impact what might otherwise be a fragile labor market at this juncture?
I do think, yes, equity markets are rightfully looking through the shutdown noise and just focusing on what are the key drivers, the secular AI trend, and the earnings season coming up, which we expect to be quite good again, double digits likely for the fourth quarter in a row. In terms of the shutdown itself, part of it is this data fog. We don't think we will get CPI next week. Still enough there for the Fed to cut rates by the end of the month. But again, the longer it goes on, if we don't have any October data, the more foggy it becomes. Otherwise, in terms of the labor market, we have seen really since January negative jobs added from the federal government, and we might even see more already without any additional measures because of some of those 6-month provisions before federal workers drop off. I do think the Fed looks beyond that, really looks at private sector hiring, and is taking a little bit of a warning sign from just the cooling there in private sector to basically a standstill, and especially only coming from an industry or two at this point.
Yeah, Waller suggested to Leisman he thinks payrolls were probably negative for the past several months.
Yeah.
We're on consumer, we're about 50 days away from Black Friday. We had a couple rough days for the XRT this week, the retail ETF. I noticed on some Chase card spend that restaurants and bars went negative in September. I mean, to what degree is that a worry? And would it even move headline given the strength of the AI trade?
So I think for consumer companies, they're in a tight spot still. So you've got just the consumer initially very focused on discretionary core goods spending, especially in the second quarter into the third. That seems to be fizzling off a bit. And then kind of trading places in terms of where the services spending is going was very weak on airlines and travel earlier in the year, but strong on restaurants, and it seems to be trading places a bit. So exactly where the consumer is spending is shifting, but the overall magnitude of it, I would still call it okay, rather than particularly strong. And then the last thing for retailers that we'll be watching here in the third quarter are margins, right? So margins have been actually surprisingly decent, despite the tariff headwinds. So what exactly are they saying about their ability to pass this on or cut costs otherwise in the third and especially into the fourth quarter?
Gabriela, thank you. Always appreciate it.
Thank you.